So today's data and release from the Halifax HPI is not going to be good news for the doom mongers. And actually, when we look at this chart, which is from today's HPI, it's starting to show quite a compelling trend, okay, in terms of house prices. Now, of course, there are caveats to this. This is a model. This is one model called a hedonic regression model. And there are loads of factors that go into this that we potentially don't know exactly how this gets worked out. But I always talk about trends. And if you look at that graph and you look at trends, there is house prices going one way at the moment, which is not down. So however way you spin it, it's impossible to sit here and say the housing market is going to crap, okay? So in this video, which is going to be a very short, snappy run through the HPI and look at a couple of other data sets, I want to talk about what the caveats are with this. What is the reason that we're potentially seeing these house prices go up on the HPIs at the moment, and some bigger macro things about what interest rates are going to be doing over the next, I would say, 3 to 6 months. So we'll crack right onto it. First of all, as we are live, if you can see me and hear me, give me a thumbs up, put something in the comments. I've just realized I've not got the comments box on, so let me get that up. If you're following through on the replay, please also put your thumbs up. And please also put your comments and your thoughts on. I'll always get back to you. And if you are new to the channel, welcome to the live stream where we run through the data to see what's going on beneath the hood, what's actually happening to enable us to make better decisions and better choices. And last time I went live earlier this week, I said I was going to be short and snappy, no more than 10 minutes. It ended up being 45 minutes. So today my aim is shortness and snappiness. So let us proceed. We can see a very definite trend on the Halifax HPI of house prices going up. My major caveat to this, and by the way, there is so little that's in this HPI, is the nations and regions and the differences. And I always say this, right? It's so difficult for us to look at the UK property market as a whole because we have multiple sub-regions. We've got Northern Ireland, which is very skewed at the moment to the upside. Scotland is looking surprisingly on the upside as well, but I know some of the large cities, Edinburgh, for example, is a very hot market right now in Scotland. Wales showing plus side. And then when you come into England, you look at the south and southeast of England is showing negative. So what was it? So southeast fell 2.3% year on year. So when we look at the overall figures, which are annual change 2.5% in the whole of the UK, when we zoom in to the regions and the other nations, the picture is different. So the first caveat with this is we always have to delve in to where the detail is. But despite that, we are now February 2024. We are still seeing on both HPIs, this and nationwide, increases. And when you look at the actual figures, the nominal figures, I'm just sorry, I know I'm scrolling around a little bit. The nominal figures here, we are sitting at a nominal increase of about £4,000, which is a fairly significant increase, especially when we had a similar sort of increase from November to December, less so October to November. But we are seeing a month-on-month nominal increase on the model. However, the model works it out. So the argument that seasonal adjustment, which changes the percentages, is skewing it, is a difficult one to make, which is why I think some of the doomsayers are probably going, how do we spin this data to the negative? Well, that's what I said. Number one is the regions. Number two is transaction volumes are still historically low. So with low transaction volumes, we have to take the data with a pinch of salt. But I just want to talk to the narrative. It's always interesting to look between the lines in what the narrative is. Look, here we go. So the end here says, and I'll read it, looking ahead, affordability challenges are likely to remain and further modest falls should not be ruled out against a backdrop of broader uncertainty in the economic environment. And this is pretty much exactly what we've been saying for a while now. Before I clarify that point, the narrative has definitely changed in this HPI, because I would say for the last few months, the narrative is we are going to see modest house price falls in 2024. We've now seen a distinct shift in narrative to we cannot rule out modest house price falls in 2024. But what is very obvious is that there is a lot of uncertainty in the system right now. And the uncertainty mainly comes with when are interest rates actually going to come down, but what's going on with the economy. We've talked about the link between house market and the economy, and that's the big unknown at the moment, is where's the economy going to go in 2024? Because if we do go into a decent recession, which many are now saying we're not, that will probably drag it down. The other uncertainty is, of course, geopolitical issues, okay, which are still simmering away, but not having too much effect right now. So I'd love to know your thoughts on all of this. What are your thoughts? Because I hear it all the time. Shop floor, out on the road, people are going, look, house prices are coming down quickly. Sellers can't sell when they are selling the massive reductions. But the figures that we're seeing don't quite marry up to that. So there is a disconnect somewhere. Okay. Now, this could just be, a lack of liquidity in the system that's skewing the data. However, we are certainly not in this massive meltdown. I refuse to believe we're in this massive meltdown. So where is this going to take us going forward? Because everybody's thoughts are now on interest rates. We've got two things we want to look at for interest rates. Number one is annual earnings, pay growth in the UK. The bank have clearly shifted their stance. They're probably talking about coming down earlier than we were originally thinking, but there's a couple of things that are holding them back. Number one is pay. So whilst pay growth stays high, I'm just going to, go up to the top here, because this is the most recent pay bulletin or pay set of statistics, which takes us from is the period September to November 23. Pay is probably one of the biggest things that they're looking at, and increase in earnings. I would also imagine they're now looking at the HPIs and going, we've got house price inflation, right? We're not negative. So we've got wage inflation, we've got house price inflation. Is this going to feed into the overall inflation? And they've already said they're expecting inflation to drop off very rapidly, but then actually come back up for the sort of second half of the year. So I'd imagine they're still going to be sitting on their hands and looking at that data. We can see the pay growth is now, in nominal terms, starting to come down. So we've peaked and coming down. And in real terms, we've gone into positive, but it's sort of flatlined over the last couple of periods. But it's still high, right? We're still in nominal, what's that, 6.6% for regular pay, 6.5% total pay. It is worth mentioning, I'm just going to scroll down and show you this. It is worth mentioning there is a very obvious, if I go public sector total here, there's a very, very obvious spike with the one-off pay awards that public sector were given. So you can see that was in the June to August period, which gone into that data. If you look at private sector, we haven't had the same. So if I put them next to each other like that, private sector did have a big spike post-COVID, which public sector didn't. So it's kind of making up for it. So wage growth is still high, but coming down. House price inflation is now in the positive when you look at those indices. So let's see how the markets are reacting to all of this. The gilts are, or 10-year gilt, which is the one I'd like to look at. I just want to put it on for a longer time period, actually, so we can see better. We did come down almost to, what's that, 3.7. Let's just go down a bit more. There we go. That's where we hit it. So we're hitting about 3.5, kind of Christmas time. We've come back up and we're kind of flirting with that 4%. So it's kind of knocking off the 4% mark at the moment. If we look at the swaps, we can see the swap rates have come up. So right now, 5-year swap is 3.85. 8th of Jan, it was 3.58. Okay, so we've seen the swaps come up. How does that feed into mortgages? Well, we've seen mortgages come down in terms of rates, but we're now seeing them flatline or in some cases start to go up. So it probably feels like that discussion about affordability, interest rates, mortgage rates right now, until the Bank of England does something, I would imagine we're getting to that bottom. Okay, so we're not going to see affordability improving anymore for people in terms of mortgage costs. So that's something to note. So the markets are probably saying, okay, look, maybe we over-egg this a little bit with interest rate cuts. Maybe they'll come later. And I actually think the market is now pushing back their expectation for the first cut from May, I think, to now June, July, or August, maybe even August, something like in the summer. So it's pushing it back slightly. Let's just look at some other factors because a lot of people talk about price of Brent crude as we feed into inflation. That's playing ball at the moment. We're at 78 a barrel. Natural gas is nice and low at the moment. So we're not seeing a huge amount of things feeding into the supply chain either, other than shipping costs for shipping going around the south of Africa at the moment. But yes, shipping costs are going to go up, but that's not going to affect everything that comes into the supply chain. So I would imagine we are going to continue to see that narrative inflation coming down quite rapidly over the next few months, unless something else happens on that. So look, that was short and sweet today. I wanted to get it as short and sweet as possible, but my overview, my overarching point here is we can't just sit here and say all these stats are everything that's coming out is BS. Everything's going to meltdown. It is a compelling trend line that we're not going into nominal house price meltdown, right? Let's just go back to it just to recap that. We have a very definite trend line up. And when we look at the rates of change, again, everything is on its way up. So all the trend lines are going up at the moment. I said last month in December, I would see probably a bounce in the January to the spring as that sentiment comes back in, as affordability does sort of relax a little bit for people as the mortgage rates coming down, not for people refinancing, but for people looking for new properties, right? Mortgage rates have come down compared to last summer. And affordability is one of the big things that affects house prices. So we'd see a little bump. I've always said we're probably going to see, well, not always, I've been saying for the last couple of months, we're probably going to see a bump in the first quarter or first half of 2024. Then, depending on what happens with the economy, it could go either way. I maintain that that is my position. I'd love to know your thoughts of what you're seeing into it, but that's my thoughts. The final thing I'm going to say against this data set is, as I always do, and I always caveat against the indices, is they are nominal house prices. As a property investor, I'm interested in real house prices. And when we look at the real house price indices, they have been crashing. Funny old thing, we're in level, pretty much flat market when you look at the last year, 18 months for house prices in nominal terms. Real house prices are significantly depressed. For me, is this, are we getting to a nice entry point? Potentially. I've been buying last year and this year. Are we getting to a nice entry point when we look at real house prices? So the house prices compared to everything else in there, potentially. So what's your thoughts, team? Let me know. As I said, I did want to just do a quick one today. Jay says, let me put this onto the broadcast. Only decent stuff is selling. The other crap is sat on the market with big reductions. When those finally sell, that'll start filtering through into the data. And I think that's a really good point. Clearly, the markets are being propped up with a lack of supply. We are seeing more supply coming onto the market. So if we do suddenly see a huge, influx of supply, that will definitely put downward pressure on house prices. I totally agree with that. Right now, we're still not in a position where we've got loads of forced sellers out there. We're just not there at the moment. Doesn't mean we won't be there in 3, 6, 9 months' time. So I agree with that, Jay, with what you say. Any other thoughts on that data? Was anybody surprised by the data, by the Halifax's data? Because I think that's quite an aggressive tick up that we're seeing now on their matrix. We're not a million miles away from all-time highs when you look at it like that, right? We've recovered most of the lost ground. We're not. If we look at the actual nominal figures, where were we at the peak? Peak here 2.8. No, that's not. It doesn't go back far enough to give us the actual nominal figures. But we're not a million miles away. So let me know your thoughts, team. But otherwise, that's just a very quick recap with the Halifax. The next data set that's going to be coming out is, of course, the next inflation data set. That's going to be very interesting to see. We'll be talking about that. I think it's next week when it comes out. Or it could be the week after. I'll check the dates on that. But otherwise, let me know. Stafford says, how many units are in the data? Good question, Stafford. I do not know is the answer to that. I'd have to delve into it. There you go. Richard says, Halifax figures are just the biggest joke. Please don't base your decisions on this. Can I just challenge you though, Richard? Because let me put that on. It's so easy just to say data is a bunch of bullshit, but it comes from somewhere, and it's not just completely made up. So these are model. And look, if anybody wants to look into these models, sorry, Steph, Richard, I will take it off again. If anybody wants to look into the methodology, okay, you can dive into the methodology. This is actually, Halifax is owned by S&P Dow Jones, and there's or S&P Global. There's a lot of information about how they come up with this data. It's all linked. So we could sit here. Sorry, that's the wrong. Oh, is that the stats? Sorry, give me a sec. No, that's the overview. We could sit here and say it's all bullshit, it's all being manipulated, but I feel that's, honestly, I feel that's not the most helpful narrative and thought process to go down. I think we need more objective scrutiny of everything. We need to challenge the data for sure. I'm not saying house prices going up like this, right? I'm saying that we have a small data set. The hedonic regression model, we don't know exactly how it works. We don't know what they've put into it. I'm sure we could find all of this sort of stuff out if we had a bit more time. But I don't think it's particularly helpful to say it's just a load of rubbish, because, and I mean, anecdotally, I've talked about this quite a lot, and this is now where we get sidetracked, isn't it? Talk about perception driving markets. And right now, I can categorically say that in a lot of circles, and not everybody, of course, there's going to be demographics that are more acutely affected. You're going to have demographics who are doing really well right now, okay? People with no mortgages and big savings accounts are absolutely flourishing, okay, with all with what they're getting in from the bank. People with houses they've owned for 10, 15 years and are still on fixed rate are doing very nicely. People who are lower income, maybe early family and over leveraged after COVID to get themselves a big old house that they're now coming off a fixed rate mortgage onto a variable rate are going to be decimated. Okay, but because we've got these subsections who are in that position, it's not the same as a whole systemic issue for me. That would change completely if we go into recession, if everybody starts losing their jobs, if we go massive meltdown, if all the companies start going bust. Yes, I agree. That's then systemic issues that are going to go across the whole country and cause these things. But right now, we're seeing little pockets and subsections of demographics who are feeling it and others who are not feeling it. I want to give you, today we won in our scaffold company a major contract with a house building company. I won't say which house building company it is, for a big site of timber frame buildings that starts next week. Right, so houses are being built. Builders are building houses. We've taken on another gang this week, and we're looking for another gang to take on next week. We're expanding again after what was probably a bit of a contraction over October to beginning of January. We're now expanding. Our inquiries board, and I could bring it up. I can't be bothered to blur all the stuff out. We use project management on something called Trello. Has gone berserk this week. Loads more inquiries coming, noticeable, and I sort of keep in touch with all of this. And my builders that I use on my own properties, and my builders are saying they're having way more inquiries in the beginning of this year than they had beginning of last year for work to be done. So sentiment-wise, it feels, anecdotally, I could be completely wrong with this, that sentiment is picking up. There's more activity. Okay, there is a slow trickle of additional supply coming onto the market, which could, again, further depress house prices if the demand's not there. We just had today an offer accepted on an investment property we're buying. And people would say, why would you buy in a falling market? I'll tell you why we buy in a falling market, because we're not buying it on a bricks and mortar valuation. We buy them on commercial valuations. And commercial valuations, because they're inversely linked to value, means the yields are inversely linked to value because interest rates are high, yields are high, values are low. So we're able to pick up commercial style or properties with commercial valuations at pretty aggressive prices right now that create a huge amount of yield, right, and a huge amount of cash flow. And then as interest rates come down again, which they will do at some point, the values will go back up. So there's lots of more complex dynamics with this. And I would say the majority of sellers that we're seeing are retiring landlords or institutional sellers who are looking to offload, things to rebalance portfolios. So there we go. So Rich saying my target areas in Dorset, West Berkshire, and Wiltshire up to 400k. All I'm saying is property sticking and then reduce. Just goes against the tide. I said there's going to be different microclimates. Don't forget, Richard, this own data set says in the southeast it's still dropping. So that is. The first thing I said was we have to know what's going on in the regions. All the regions are going to be different. Of course, the south and the southeast, southwest is probably on a negative trajectory still, with other lower value areas, north, northeast, northwest, probably picking up because actually it's still cheaper to go and buy stuff up there than it is to rent. Northern Ireland has got a massive lack of supply. I'm not quite sure why Scotland seems so strong at the moment, and why some of the cities. So I've got a client who is based just outside of Edinburgh. He says that Edinburgh is so hot right now, he cannot buy anything. Everything goes like that, really hot. So there are massive difference in micro markets, which I just think it's important to not look at the local area and go, that's what's happening everywhere. It does vary. So there we go. There's my point. I'm not saying, by the way, that there aren't great deals out there. I'm saying there are reductions. I think we've got two very different markets right now. I think the residential market and the investment market are in two very different places. I would say I'm not particularly interested in the residential market as a property investor. When I say residential, I mean standard homes, family homes, which is different to the sort of stuff that we do. So in terms of sellers being unrealistic, they probably are being unrealistic because they're not motivated to sell. So if you're not motivated to sell, you're not a motivated seller or for seller, you're not going to have to drop it too much. There's probably also less people buying because people are sitting on their hands and waiting for the interest rates to come down. That's very different, I would say, to the investment or the commercial sector, which is in a very, very different place. Probably because they got rid of Nicola Sturgeon. Cool. All right, team. I am going to end it there. It's still like 20 minutes rather than 10. I hope that was useful. I think I love these things. It creates debate. And I think one of the best things that's creating debate at the moment is all the figures saying property values are not crashing, whereas anecdotally everybody's saying, but they must be because they're not selling and price reductions are coming on. And I agree. And I think this is a really interesting conversation that we need to be having. Honestly, my opinion is I don't particularly care as long as an investor, we can get returns on our capital, that are very attractive. And for me, that's, I target a minimum of 30% return on capital when I go into a property development or property deal, which is to buy, add value, recycle funds, cash flow it. I want 30% of whatever funds I leave in it as a minimum, but generally I'm sort of looking for 50% plus. And we can do that with a lot of models right now. It's a very exciting time to be an investor if you're looking in the right place. But high value 400 grand family houses in the southeast is not that place. I can assure you, right? I wouldn't even be dreaming to be looking in those sort of areas, and with that sort of property model. I'll leave you with that, team. It is the channel's birthday today. Apparently, I put out a little thing on the community. So happy birthday to the channel. I think it's 10 years old today, even though I've only been active and putting stuff out for 10 and a half months rather than 10 years. Look, if you found some value and you enjoy looking at these stats and having these conversations, which I do, please do subscribe to the channel. Find that subscribe button now. If you're new, do it. If you come back and watch, but you're not subscribed, please do it, because it's the one thing, it's the biggest thing that YouTube likes to give you reach. And of course, we're growing this channel to try and build a community and help people to take back control and ownership of their own finances by looking beneath the data, which could be BS, but understanding where the actual value adds are right now. Rab says, Charlie boy, we love the fact that prices aren't dropping 35%. I didn't want to mention any names. So look, you know, if you're watching regularly, you know that trends are the most important thing to me. And I just think it's an undeniable trend. I'm not saying that trend isn't going to reverse. I'm not saying the economy will not go into absolute shit state in the next 3 to 6 months. And we get, a geopolitical thing comes in from left field and takes us down into a horrible place. I'm not saying that. I'm saying with everything I'm seeing at the moment suggests soft landing for the property market. If you go back and watch my videos I was putting out last year, I suggested that we'd probably trough. I thought Q3, Q4 2024, which is this year, so end of this year, I thought it'd be troughing in nominal terms, but real term price drops probably for another 2 or 3 years after that. So trough and then stagnate. It's possible that we've troughed earlier and we're going to stagnate for longer. And when I say stagnate, it's going to be, up, down, up, down, up, down, but we'll see. History will tell us who's right and who's wrong. I don't like to say if we're right or wrong. I just like to look at the trends and analyze where the trends are going. So I'll leave you with that, team. Hope you have a good end to the week. And look, there's going to be some inflation data out soon, which I'm sure we can have fun chewing through. So we'll do that. So as always, stay safe and I'll speak to you next week. Have a good one.